All right, let's talk about bond yields and the fact that they have been climbing not just here in India but also in the United States. What does it mean? In India, specifically, you have the Monetary Policy Committee of the Reserve Bank of India that has maintained its accommodative stance despite the fact that inflation has been inching higher. What does it mean that the bond yields have started inching up despite that fact? To speak about the context that we're currently in and also to tell you how you should look at constructing a fixed income portfolio, joining me now is Suresh Sadagopan, who is the founder of Ladder7 Financial Advisories. Thank you so much, Suresh, as always, for taking the time, and wish you a happy new year. Let's start with the most basic question. What's the context right now? Why are bond yields and in fact treasury yields climbing at this stage? What does the investor need to understand?
Okay. So let us look at the India situation at this point in time. So, India was slowly climbing out of the COVID-related growth impact, and now we are again impacted due to Omicron, and there is expected to be an impact. I heard you saying that the number of cases have gone up across the country. Okay. And it looks like it is steadily climbing. So this is going to have an impact probably in the first quarter of this year. So growth can potentially get impacted. So when RBI looks at it, they would not want the growth to be impacted, and they may want to support that and support the growth and employment at this point in time. It has been a tentative growth. It has been decent, but this can actually play spoil sport at this point in time. So they may want to support that. And for that, they need to continue to have the interest rates low for helping the businesses tackle or rather help them to grow. But at the same time, inflation also has been a nagging worry of RBI, and it has been slightly out of their comfort zone. But inflation targeting or growth targeting, so that is what the RBI has to decide now. So higher rates may be needed so that the money gets invested if you want to do inflation targeting. But my sense is that probably for some time to come, probably for the first quarter and the second quarter, RBI may look at growth targeting rather than inflation targeting, at least as of now. So let us look at the other thing which is also happening. If you look at the US, which is a very significant market for all across the globe. So the tapering by Fed, that is the buying of securities by Fed may end in early 2022, or that is the expectation. There also inflation has gone up sky high. They have not seen this kind of inflation for a very, very long time, 6.8% in 2021. And inflation is due to supply side bottlenecks and strong demand in the US. So they are expecting to increase the basic interest rate by 25 basis points 3 times this year, 3 times next year, and another couple of times. So that is a broad expectation, roughly taking it up to 2%. So that kind of a increase globally will also have an impact on the interest rates in India. Because that parity has to be maintained between Indian rates and rates abroad, because otherwise the money will flow out. Also, Government of India has its own borrowing program, and if you are borrowing higher and higher amounts of money from the market, you have to necessarily pay higher interest rates. So there are competing forces at play here. So that is where that is the lay of the land as of now. So, and as far as the flattening of the curve is concerned, which you mentioned, Alex, so it is kind of signifying that probably there is an expectation that credit will probably move up. There is an expectation that the interest rates will start going up. When the interest rate starts going up, it will happen at the shorter end first, and then it will move on to the longer end. So probably there is an expectation there like that, and you are absolutely right. So it has been slightly narrowing, the shorter end to the longer end. Flattening of the curve is happening.
I want to talk about that in more detail though, Suresh, and I want to understand so that my viewers understand. And by the way, viewers, if you were wondering about the yield curve and you aren't a finance student, you probably remember in school you had the x-axis and you had the y-axis. It is essentially the period of borrowing of the government. So the very short end is on one side of the spectrum and the long end is on the other side of the spectrum. If you imagine a curve which is essentially the yield curve, you have what is called a steepening of the yield curve and a flattening of the yield curve. So now we're talking about, Suresh, the flattening of the yield curve, which brings me to my next question, which is what do you anticipate will happen? You've already given us an inkling as to what you see happening in the first couple of quarters of 2022, but what do you anticipate will happen, and what does it mean when you say that the yield curve is flattening?
So what it says in very simple language is that the normally shorter term yield is at a certain level, and longer term yield is at a much higher level. So that is normally how it is. So the longer you hold, the higher the risk, and typically you should be paid for the risk. Okay, and also keeping that money for a longer tenure with whichever party. So now what is happening is the shorter tenure also is the differential between the longer tenure and the shorter tenure is decreasing. So that is when we are talking about the flattening of the yield curve, where if you go from 1 year to, let us say, 10 years, it will not be very steep. It will be kind of a moderate kind of a curve. So that is what we are talking about. So because of the various factors I told before, the expectation is that the first 2 quarters probably the rates may not rise. Okay, in spite of the inflation, whatever we are seeing, the rates may not rise, even probably in the second calendar quarter. But after that, if the growth normalizes and RBI wants to target the inflation because the growth is on track, then the rates may start rising from the second half onwards. So that will be felt on the short duration first, like I said before, and it will also catch up on the longer duration over a period of time. So we will have to look at the short duration first.
Absolutely. Now, quite often, Suresh, when it comes to fixed income, and specifically I'm talking about the investments into debt mutual fund schemes, there is often an approach that is made by investors to invest on a goal-based approach. So if they say that they have a relatively near-term goal that they want to achieve and they don't want to take the risk of equity, then they park the money in fixed income products, debt mutual fund schemes included. But there should also be an approach in terms of building of a portfolio. You should certainly have long-term holding of debt mutual fund schemes, particularly because of the tax implications of that, but also because it's good for your portfolio overall, right? So assume that somebody is coming to you and saying, I want to build a fixed income portfolio in the current context at the start of 2022. How does one go about doing that?
Yeah, so Alex, I'm not only going to talk about today's situation, I'm going to talk in general. Because even though today's situation is going to be transient, and the way we construct a fixed income portfolio typically, I mean, that is good for all time to come. Okay, so we will have to look at the investment horizon. So what is the horizon for which they want to invest? So what are the goals coming in? So it's a great idea to match the tenure of when the goals are coming up with broadly the tenure of the investment in the debt product that you are doing. So are you having any income and liquidity needs? Do you want to lock it in? Do you have regular income needs? So that is something that we will have to look at it. Are you looking at some of the portion as a long-term strategic investment allocation based on the asset allocation required for your portfolio? So that is also something that we need to look at. What is the risk that one is willing to take? Normally, when we come to the fixed income portfolio, we tend to not take too much of risk. I mean, the fixed income portfolio is typically for generating an income or giving stabilizer to the portfolio itself. It's like a bedrock of the portfolio. So look at it from that point of view, we would tend to stay with a high credit profile in the debt portfolio. And we will also have to look at post-tax return. So that will determine what kind of fixed income products that we want to invest in. Like, for example, in the case of a debt fund kind of a product, we are looking at a capital gain treatment as opposed to, let us say, a bond or any other product, NCD bond, where the interest income or the coupon which you are going to get is going to be treated as income. So we will have to look at the post-tax returns also. So overall, if we had to look at it, it may be a better idea to invest in a debt mutual fund. Like I said right at the outset, debt mutual funds, especially if you are willing to hold for say 36 months or over, then it is treated as long term. And the long term, you can actually take the advantage of indexation, and you will be paying tax only after on the indexed price minus the selling price. So essentially, long story short, it is going to probably the tax is going to be probably in single digits, which means it will boost up your investment returns massively. And the other very important thing which we have to keep in mind is that there is an expert there who is backing you up. In the case of any debt mutual fund, there is a fund manager who is backing you up, and this person, he or she, will be navigating the market for you and taking all the right decisions at all appropriate points. So, I mean, a debt fund is an appropriate product to navigate this space, and it is also very tax efficient, like I have said, and it is also liquid. So, a great product to navigate this space will be debt funds for most of the retail investors. There are going to be other investors who may want to invest in bond and NCDs and other products as well. That will be case specific.
Absolutely. I just want to elucidate that point, Suresh, on the tax aspect of it. That is one of the USPs, in fact, of debt mutual funds. If I were to say that a fixed deposit is available at 6% right now, over a 3-year period, it would essentially give me 4% net of tax, right? If I'm in the 30% bracket, because you are knocking off about 1/3 of the return. You've done studies as to how much on an average with indexation one would achieve in a debt mutual fund, just to give that comparison?
You are talking about FD versus a debt mutual fund and what kind of returns, that is what you are saying?
Absolutely. Yes, yes, absolutely. Post-tax.
Post-tax. So let me take a very simple example of a FD which is giving 7%. I mean, don't ask me which FD gives 7% now. Just an example. So suppose an FD is giving 7% example, 7% return, and you happen to be on the 30% tax bracket. So what happens is roughly about 4.9% is the effective return after the tax. Okay. So in the case of a debt mutual fund, so the effective return, let us assume for a moment that the debt mutual fund is also giving a 7% return. And let us also assume for a moment that this has completed the 36-month tenure. So once you have indexed that for inflation in the intervening period, is the 36 months, and after that is the index cost, and whatever is your whatever is the sale price of the units. So in the case of capital gain, we always sell units. So what is the original price of the units now adjusted for inflation? What is the current sale price? Sale price minus adjusted price is what is the tax. On that you will be paying that 30% as applicable. But the effective tax will be so low that your net take home from the debt mutual fund will be probably 6.5, 6.6. It all depends on the cost inflation index, which is essentially a factor of inflation. So, but it will be significantly different from what you are going to take home from an FD or an NCD or any other product which does not have the capital gain dispensation. So the difference can be very significant. Like in this hypothetical example, 6.5 versus 4.9. So it's very, very significant from the point of view of an investor. Does that answer, Alex?
Especially if you... Absolutely, it does. Because what I was trying to get at is, if somebody has an asset allocation strategy, Suresh, and even if they're doing a 60-40 or a 60-30-10, 60 in favor of equity, 30 in favor of fixed income, and 10% in favor of gold, then that 30% has to be invested in a manner that is both efficient in terms of the returns, but also efficient in terms of the tax aspect of it, right? Because if you're thinking about even that entire 30% put in fixed deposits, as opposed to some portion being put in fixed deposits and others put in more tax efficient products, then that would be the beneficial way to go. But specifically speaking about the current context, Suresh, I also wanted to talk to you about this. How do you tactically utilize the current context? Because what I'm trying to get at is how would your selection of mutual fund schemes, debt mutual fund schemes, change when you anticipate that there could be a further flattening of the yield curve?
Correct. Good question. So at this point in time, the first underlining thing which I want to mention in all cases is that we are looking at good quality underlying papers. Whether it is short term, medium term, long term, I would suggest good quality underlying papers. So don't go for credit yield funds. That can give higher yields, but it has its own negatives. So short-term funds are preferred currently, especially we are talking about the yield curve flattening. Reinvestment at a higher rates is going to be a big advantage in the case of a short-term product. And the more important thing is that if the short-term product is giving a certain return and the medium-term product is giving something similar, maybe 50 basis points higher or 40 basis points higher, there may not be any major merit in actually going for the higher return, higher tenure products. So I would suggest at this point in time, short and medium term. So when I was looking at the short and medium term tenures, I was pleasantly surprised that even the medium term, many of the funds are operating at around 3%, and many of the short term funds are operating around 2 years. I'm talking about modified duration. Average maturity is modified duration is about roughly 2 years for short term and 3 years for medium term. So if the duration is 3 years or less, I would say that is okay for now. Corporate bond funds, banking and PSU funds, and dynamic bond funds can of durations less than 3 years can be considered for now. Lower the duration, the better it is, because when we reinvest that, potentially we will be reinvesting at a higher return. So currently for now, that is good. So the next question is, do we not invest for long tenure at all? No, the answer is not that. Long tenure funds also we can invest if we are allocating strategically in the portfolio and for the long term. And if you want to invest like that, hold to maturity funds like Bharat Bond Fund or roll down fund, which you will hold to maturity for a long duration, like maybe 8 or 9 or 10 years. That kind of thing is fine. So for example, Bharat Bond Fund has AAA rated papers. A roll down gilt fund or a target maturity fund, gilt fund, will have Government of India papers. So they are good to have, they are good to hold for the long duration. There can be, you can say, volatility in between, but if you are holding to maturity, it should not really matter in your overall portfolio.
Because you're also protecting yourself from capital loss, right, Suresh, in the event that you have interest rates climb. If you are on the longer end of the spectrum and you don't intend to hold to mature, or you're not in a hold to maturity product, you will face capital loss, right?
Correct. So that is why if somebody wants to invest for the long term and they don't require that fund and they are very clear that this is a long term strategic allocation, they can look at these kind of funds where it is held to maturity. They don't worry about the volatility in the intervening period.
Absolutely. Thank you so much, Suresh, for this lovely chat. I think we've covered all the bases, including the context that somebody needs to know about if they're investing afresh. Thanks once again for taking the time.
Thank you, Alex.